Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What happens, as we said, people hide in the treasuries. If you hide in the treasury bond market, in a big portfolio player, and that's the only place you can hide. I use the example, you can't hide in the Malaysian bond market, $300 billion. You have to go into the U.S. market. You're not going in there to buy the dollar. You may hate the dollar like heck, but you're coming back to hide. You're thinking return of capital in these situations, not return on your capital. So return of capital means you hide right here, and the dollar goes up regardless of what's happening in the U.S. And that was the mistake people made in the credit crunch when they thought the dollar would crater. It doesn't because of this factor. The U.S. consumer could go into a shell. And one of the reasons this major risk bid scenario is important is because if we see this again, this will be another major problem in a very, very short time period. So we think this major risk bid scenario, and I didn't make this point earlier, and this is one of the key points of this, we could see the dollar bounce and be sustained. And the reason we think it could be sustained is this. If the U.S. consumers that are getting a little bit of wealth effect from the stock market and a little bit of turn in the global economy, and all of a sudden they get whacked again, you can bet they're going to go into their shell in a very, very big way. And that money is going to go very, very, what money they have and any future money will continue to pay down debt, and you'll see an even faster deleveraging in the private economy that will overwhelm any ability of the government to provide stimulus. You'll see U.S. savings soar, and you'll see exports coming out of China decline because our imports will fall off tremendously. So this is an area where you could see capital coming back to the U.S. in a very big way and not leaving because people are just so jaundiced at this point after being hit twice within, a couple years in a very, very big way. And that's why if we see one of these, we don't think it's just a bounce. We think it's a sustained move in the U.S. dollar. And this idea what we talked about before of global rebalancing all of a sudden wins in a very big way. Think of yourself as the government right now, and say you're the head of the Treasury, and you're getting together with your buddies in the G20 around the world, and you say, hey guys, we just pumped $17 trillion collectively into the global economy, and we have no demand really anywhere. 2.5 million small businesses have gone bankrupt. U.S. unemployment's 10.5%. We've created no global inflation whatsoever. In fact, headline consumer prices are falling. They got to be staying up tonight because if this happens, they're out of bullets. They're running out of our money to stimulate the economy, which isn't working. Interest rates are already zero. They can't go any lower. So this is a scenario in which it really changes the game and creates a massive deflationary problem for the global economy. We happen to think deflation is already a problem in a big way, and we wrote a deflation report that you can get at our, send us an email, we'd be happy to send that to you, a report on deflation, and we think the prospects of it are very, very big, and if we see this, it's almost set in concrete. So we could see long-term U.S. interest rates that are now 3.5%, go to 1.5%, kind of Japanese scenario. So they got to be up at, really, if they're thinking about this stuff, and I know they are, very, very nervous. And that's why you're seeing the degree of quantitative easing and the degree of things happening that we never would have seen before. They're very much afraid of this again. They cannot allow this to happen again because they are out. They're out of bullets. The stimulus process they're doing, their choice to try and refunnel that symbiotic relationship of more U.S. consumer as opposed to letting the market work this stuff off, they've chosen this path. And if they fail, it's lights out for a while. So that's the kind of a scary scenario we have. But as you can see, there's a probability that it could happen. And it would be a big move in the U.S. dollar and sustained, and that's one of the things that we're watching for. Key plays on the weak dollar scenario. Australian dollar, obviously. This is a chart of the Australian dollar. It's a weekly chart. As you can see, before the credit crunch, the Australian dollar was almost approaching parity in the U.S. Credit crunch time. Remember what I said, the commodity dollars that have moved so much on liquidity tend to get hit the most. Look how hard the Australian dollar was whacked, and look how fast and much it's come back on yield and growth. And if the U.S. is continuing to fund the global economy and the money keeps being pumped out there in a big way, and China keeps the music playing, there's no reason why the Australian dollar can't continue to go higher and ultimately get to that parity level, given the growth and the yield advantage it has. No doubt it looks overbought on any technical level, but it may have looked overbought right in here and smoked up again. So the reality is we have to just continue to stay with this trend until some of the fundamentals may change. On the ISE, if you're trying to look for Australian dollar, US dollar calls and buying calls for this to go higher, the root symbol is AUM. So you would go into your system and just type in AUM, and you'd get an options chain that would look like any other stock options chain and give you all the different choices and all the time frames out there to buy US to Australian dollar calls if you think that the current policy is going to stay in place. The other weak dollar policy, as I said, is the euro is another play. It's a mirror image of the U.S. dollar. It's 54% of the U.S. dollar index. Actually, I think it's about 58%. Excuse me. So the U.S. dollar index down, the euro tends to be the mirror image. Right now, the ECB, European Central Bank, the perception is it's a lot more aggressive than the U.S. And a lot more conservative. That may not be true. They've done a lot of stealth quantitative easing, but that gets into some technical stuff. But in general, this is the perception, so that's helping. And their interest rates are still slightly higher than the U.S. Well, they're a lot higher on the front end of the curve than the U.S., so they have a yield advantage. And Germany looks like it's recovering. We've seen a little bit of a rebound in Germany. That's important for the euro. Remember, Germany is the center of Europe. It's the engine of growth for Europe. So those factors really have, there's some positive factors there, excuse me, in the Eurozone, even relative to the U.S., besides the fact that it plays the mirror image. So we've seen this nice move in the euro. One of the things that we've noticed lately is this is a weekly chart. It's having trouble getting above that 150.60 area. Didn't do it today. We happen to be short the euro today. Because we were looking for a stock market correction in the spot market, so something to keep an eye on. But again, if this is just a correction in the stock market, there's no reason the euro can't, maybe just correct in here. And we're looking for a short-term trade and go back through this high, and because its old high is around 160, so it still has plenty of room on a weak dollar play to go. Japanese yen. This is something that long-term, we're going out March, going out June, going out even 10 months. For those of you who have a longer-term perspective and some, just some patience, the fundamentals in Japan are ugly, ugly, ugly. There's no other way to say it. No matter how you slice the fundamental outlook of Japan, it's horrible. Deflation has gripped the country to a degree it hadn't in the last, 15 years. It was worse the last 2 months than it's ever been to deflation in Japan. It's hard to do when you consider that they've pumped so much money in the Japanese economy. It kind of sounds like what the U.S. is doing. They've boosted the debt to GDP in Japan up to over 200% of GDP at the moment. I think the U.S. is around 80, middle 80s or something at the moment. Japan is over 200% of GDP debt. What did it do for their economy? Nothing. They've been in, like I said, about 14 years of continuous deflation, and it's getting worse. Tax revenues are falling at a time in which they need more stimulus. They're going to issue more bonds. They may be downgraded by Fitch. So we think that this move in the Japanese yen, now this is with dollar yen, so as it goes down, it's appreciating against the U.S. dollar. This move in the Japanese yen, we think, even if it comes down more, is so extended beyond belief. So long term, we happen to think, 6 months a year we're looking out here and we're looking back here and we're just saying, in here, how did we miss it? And we don't want to miss it based on the probabilities, because the fundamentals, as we said, are ugly, ugly, ugly if they get a downgrade on their debt. And if for some reason interest rates spike, even a small move in interest rates, which happened the other day, creates panic in Japan with 200% debt to GDP.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.